How exactly has Warren Buffett, one of the most successful investors of all time, consistently beat the market over many decades? Since taking over Berkshire Hathaway in 1965, he's delivered an average annual return of about 19.8%, compared to roughly 10% for the S&P 500 over that same period. That might not sound too dramatic at first glance, but over 50 years, that difference is compounded into a mind-blowing figure, turning thousands into millions and millions into billions. But the interesting thing is, you don't need a lot of money to do what he's done. In fact, he says it's way easier to get great returns with a small portfolio. In an interview, Buffett once said, "I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that." He wasn't claiming to be smarter than everyone else. He was pointing out a huge advantage small investors have: flexibility. When you're managing a small portfolio, you can go after opportunities that are too small or too obscure for the big players to touch. He even said that his best decade as an investor was in the 1950s when he was working with small amounts of capital and routinely earning returns of 50% per year. Why? Because when you're managing $1 million, the investment universe is wide open. You can buy small cap stocks, special situations, micro caps, and niche value plays without worrying about moving the market. But fast forward, and today Buffett is managing over $300 billion at Berkshire Hathaway. That kind of money comes with a very real limitation. He can't afford to think small anymore. His largest holding, Apple, is worth about $60 billion. And if he wanted to buy a stake in a company worth, say, $500 million, he'd practically own the whole thing, or drive the price up just by trying to build a position. Even if he managed to make a $50 million profit by doubling a small investment, it wouldn't even move the needle on a $300 billion portfolio. But for a small investor, that kind of return could be a game changer, doubling your investment in just over a year and a half compared to around 7 years with average S&P 500 performance. Buffett summed it up perfectly. It's a huge advantage not to have a lot of money. And that's the part most people miss. The very thing that feels like a disadvantage, being small, can actually be your greatest edge. Let's break down what he's said over the years that gives us a peek into his investment mindset. Whether you're new to investing or already deep in it, there's something for everyone to take away here. Buffett's strategy starts with a simple but powerful idea: buy great businesses, not just stocks. He's not scanning the charts or watching TV for hot tips. Instead, he looks for companies with durable competitive advantages, often called economic moats, things like brand power, cost advantages, or high switching costs that keep competitors out. He once put it like this: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Translation: you don't need to find the cheapest stock, you need to find the best business, and make sure you're not overpaying for it. That one idea can prevent a lot of investing mistakes. If there's one thing Warren Buffett is famous for besides picking great businesses, it's his patience. His ideal holding period? Forever. And that's not just a clever quote, it reflects how he actually invests. Buffett looks for companies he believes can perform well over decades, not just for the next quarter or the next earnings report. He once said, "The stock market is a device for transferring money from the impatient to the patient." In other words, the real rewards in investing go to those who can sit tight and let compounding do the heavy lifting. Holding onto a strong business over the long haul doesn't just lower your chances of making emotional, knee-jerk reactions. It also minimizes taxes and trading fees and lets you benefit as the company reinvests profits and grows. Constantly buying and selling without giving a solid investment time to grow just exposes you to all the short-term market noise, instead of letting the investment mature and actually deliver meaningful returns. But it's not just about being willing to wait. What sets Buffett apart is that he invests with conviction. He doesn't buy stocks with the idea of flipping them in a few months. When Buffett makes an investment, it's because he genuinely believes in the long-term strength of the business and the future of the industry. He's not playing short-term games. He's planting seeds and giving them time to grow. One of Buffett's most underrated strengths is knowing what not to invest in. He's always emphasized the importance of staying within your circle of competence, only putting money into businesses you truly understand. If something seems too complicated, too speculative, or just outside his expertise, he has no problem walking away. As he puts it, risk comes from not knowing what you're doing. That's why for years, Buffett steered clear of most tech stocks, not because he thought they were bad investments, but because he didn't fully understand their business models or how to value them. It wasn't until Apple became more of a consumer products company with a clear brand and predictable cash flow that he felt confident enough to invest. And when he did, he went big, and it became one of his most successful investments ever. Another great example is crypto. While many investors chased Bitcoin and other digital assets hoping for quick gains, Buffett openly admitted he didn't understand them well enough to justify putting money in. Instead of getting swept up in the hype, he stayed true to his approach and avoided the crashes that followed those peaks. You don't have to invest in everything. In fact, one of the best ways to avoid losses is just to say no when something feels unclear or beyond your understanding. Buffett's success isn't built on knowing everything. It's built on having the discipline to only act when he's sure. Buffett got his start under Benjamin Graham, the father of value investing. In the early days, that meant buying so-called cigar butts, companies so cheap you could squeeze a few more puffs out of them. Over time, he evolved. He realized that a great company at a reasonable price will usually outperform a mediocre one at a cheap price. But the core idea remained: only buy when you're getting more value than what you're paying. This discipline keeps you from overpaying just because everyone else is excited. Buffett has always been a contrarian, but not in a loud or flashy way. Instead of chasing the hottest trends or following the crowd, he tends to pull back when markets are euphoric and lean in when others are scared. One of the clearest signs of this is how he accumulates cash during bull markets, especially when stocks are hitting all-time highs and valuations seem stretched. When investors are celebrating and throwing money at anything that moves, Buffett is often doing the opposite, holding back, building up dry powder, and waiting for a better entry point. Then, when panic sets in and prices start falling, that's when he moves. You could see this play out during the 2008 financial crisis, and again in the COVID crash of 2020. While many were dumping stocks in fear, Buffett stepped in to buy high-quality businesses at discounted prices. His ability to act decisively in those moments isn't just a personality trait. It's the result of discipline, patience, and always being prepared. Buffett doesn't try to predict crashes. He just waits for times when good companies are suddenly on sale, and then he buys big, while others are paralyzed by fear. It's not timing the market in the traditional sense, it's recognizing value when it reappears and having the cash ready to take advantage. Even in his 90s, Buffett still spends hours every day reading annual reports, financial statements, newspapers, basically anything that helps him understand businesses better. For him, investing is a lot of hard work and digging through details just to find one good opportunity. Finding even one great company takes a ton of research, but the upside is that just one pick can generate huge returns. He studies the numbers, the business model, the people running it, and how he's likely to do over the long haul. Buffett's also not afraid to change his mind. Just like how he learned more about Apple, he realized it wasn't just a tech company, it was a brand with loyal customers and real pricing power. That's why he bought a big stake, and now Apple is one of Berkshire's largest holdings. What this shows is that being right doesn't mean you have to be first. Sometimes it just means being willing to keep learning and update your views as you go. Buffett has been humble enough to admit that luck played a role in his success. He was born in the right place, at the right time, with the right mentors. But he also points out, luck can only take you so far. Discipline is what keeps you in the game. Now here's the twist. Despite all of this wisdom, Buffett has repeatedly said that most people shouldn't try to beat the market at all. If you're not willing to do the research, stay rational, and hold for the long term, your best bet is just to buy a low-cost S&P 500 index fund and stay the course. Or at the very most, consider a hybrid approach. Maybe take 5 or 10% of your portfolio and put it into investments with more speculation, and keep the rest in an index fund or ETF. In Buffett's will, he's directed that 90% of his wife's inheritance be invested in the S&P 500. That's how much he believes in it. So how does Warren Buffett beat the market? He stays calm when others panic, he buys quality at the right price, he doesn't follow the crowd, he focuses on the long term and never stops learning.